Hello everyone, it's Ari here. I'm going to talk today about insider trading. This is the second lecture, and in the first lecture I discussed insider trading and defined it, and I showed you where you can find the data on insider trading at a website called Open Insider, and we went through an example called Titan International, and we looked at the insider purchases and trading behavior from Maurice Taylor. And since making that video, actually the stock has gone up significantly, which is evidence in favor of insider trading when interpreted correctly being valuable for making stock picks. Today I want to talk about the various examples of insider trading so that you know better how what's illegal and what's not illegal. So this is all considered legal insider trading from what we know now, but it helps to look at the illegal cases to get a sense of where the boundaries are. And it's also quite entertaining. So if we go to SEC and insider trading enforcement actions, you can click on the first link, SEC enforcement actions, and you can see a history of insider trading cases. And for each one, it describes what happened. So the SEC says illegal insider trading occurs when a security is bought or sold in breach of a fiduciary duty of trust. It can include the tipping of such information. So that includes if you're on the board of a company and you tip your friend about the upcoming earnings announcement, whether it's going to be a surprise positive or a surprise negative, that can have implications for you even as a board member, even if you did not trade, because you're violating the trust or breach of fiduciary duty. Insider trading continues to be a high priority area for SEC enforcement, and they are nowadays, as a side note, are using automated methods to mine the vast amounts of trading data that happens every day for evidence of insider trading. And they've picked up, and so in recent years they've picked up their pace and they've been filing claims against more and more people. And this includes financial professionals, hedge fund managers, corporate insiders, attorneys, and others for tipping or trading. And the reason it's generally this class of people is that these classes of people have or can obtain and profit from information that's non-public. And hedge fund managers are usually in the business of, I was at Wall Street at a mergers and acquisition firm and was about to accept a job at a hedge fund, and I know that these hedge funds pride themselves on doing the most due diligence possible on an investment, and they don't just read analyst coverage reports and the news and the earnings call transcripts or all these various public information. They go out and they gather non-public information. Oftentimes it's not illegal, so hedge fund managers are allowed to go interview past CEOs, past CFOs, current employees, suppliers of the company, and customers of the company, and gather feedback and make a trading decision based on that information. It takes effort to get that information. It's not easy to get. And so they should earn a return because they exerted effort to get the information at a cost. But sometimes it goes too far. Sometimes an employee may tip the hedge fund about an upcoming release, say from Apple, of a new iPhone version. And that could have huge implications for Apple's stock price. And the employee may know because he's working on that project. So it's not always the people at the top who have the private information. It can be the employees. And so it's very easy for hedge fund managers to potentially get access to non-public information. They may do it intentionally, There's strong incentives to do it because you can earn quite substantial rewards, but they may do it accidentally too. They may be, in the course of talking to people to gather information, they may come across a piece of information that's insider information. And what's difficult there is that as soon as they have that inside piece of information, they technically are no longer allowed to trade. So some hedge funds are very careful. They will refuse to talk to certain people because they don't want to risk the idea of someone blurting out to them insider information and then restricting their ability to trade. Anyways, going through some of these examples. So in 2014, you can see that 2 traders in Chile were charged. And if you click on the link, you can get some more information. They have a press release for each of these. So you can see that the SEC charged 2 associates, business associates, colleagues in Chile with insider trading for non-public information that one of them learned while serving on the board of directors of a pharmaceutical company. The agency obtained a court order to freeze the assets in the U.S. brokerage accounts used to conduct the trading. And then they describe more detail. The SEC alleges that one of the people, Juan, exploited highly confidential information from CFR Pharmaceuticals board meetings at which a tender offer by Abbott Laboratories was discussed. So what that means is Abbott was considering a tender offer, which is a way for another company to acquire a major stake in a target company. So Abbott wants to own shares in CFR Pharmaceuticals, and Abbott can launch a tender offer, which means they go to the market for CFR shareholders and say, we will buy your stock at a certain price. If it's a fixed price tender offer, they'll say, we'll buy your stock at, say, $30 a share. And everyone who tenders their shares will effectively sell them to Abbott, and then Abbott will get a stake in the company for CFR. And this usually implies that the price of CFR should go up because Abbott will have to provide a premium over the current trading price of CFR shares in order to entice the investors to sell their shares. So Juan was a board member and learned about this potential tender offer from Abbott. And in a U.S. brokerage account of which he is a beneficiary, he caused the purchase of millions of dollars worth of the shares, or in this case, American Depository shares of CFR Pharmaceuticals. So American Depository shares are shares. They're just shares for a foreign company listed in the United States. So on the basis of that information, he was purchasing millions of dollars worth of the stock. And he used Tomas Andres to place the trades in the brokerage account. And he also purchased a couple $100,000 worth of the security. When Abbott announced the tender offer, they sold and they made about $10.6 million in illicit profits. So you can right away see that this could be a very, very lucrative. In a very short amount of time, they made a substantial amount of money, and there's no risk. They knew that there's no risk in terms of the trading profit. They know that they're going to earn this trading profit. And the SEC was able to catch them. And so this is one lesson, is that if insider trading is more watched for around big events like a acquisition or tender offer, when the stock price tends to move substantially. And so you can expect the SEC to be going through all the trades. So if you don't want to be doing anything suspicious around such a circumstance. And I know many people who work at companies as regular employees with no financial background who decide to buy stock in their company because they learn it's going to be acquired. But that's illegal insider trading and is punishable. So be very wary about trading on information that's not public. And so that's the end of this story. And if you go, there are many, many similar stories. So a corporate attorney and wife. So the attorney and his wife were charged with trading confidential information. So presumably the attorney was privileged with information from his clients and tipped his wife, who then traded in a separate account. And presumably the attorney thought that they weren't going to get caught because the trading was in the wife's account, not his account. But the SEC is able to identify suspicious trading. I mean, it's kind of easy if you think about it. If the wife never has held an individual stock before in her brokerage account, or if she never trades really at all, and all of a sudden she goes and she buys hundreds of thousands of dollars worth of the stock days before an acquisition occurs, it's pretty easy to pick that trade as something suspicious to go investigate. Whereas if you were holding the stock for years and you learned about non-public information, say about an acquisition, you may trade on that information via not selling your stock, but that's not going to be easy to detect. So the SEC probably would never press charges against you. It's these people who come into a situation in a very unusual way, buy hundreds of thousands of dollars of stock when they normally don't do it. So you can imagine it's harder actually to identify insider trading for hedge funds because they place hundreds of trades usually and go in and out often. So it's really difficult to say that their trading activity is unusual. So CEO and a close friend. So SEC charged a former CEO and a close friend he tipped with confidential details about his New Jersey-based company's non-public merger. So presumably the CEO was tipping the close friend, and the close friend was trading and making a profit. And so this is an example of both the CEO being in trouble and the close friend. So really, if you care about people, you won't tip because you not only will get in trouble, but your friend will likely get in trouble too. Let's see. Roommate of a hedge fund analyst and a friend. Two individuals were charged with insider trading ahead of announcement that the hedge fund Pershing Square Management was taking a $1 billion short position in Herbalife. So presumably the hedge fund analyst working at Pershing Square knew about this position, this short position, which was obviously going to lead Herbalife stock to fall substantially on announcement. And the friend probably bought options or shorted the stock to profit from the downside and made a substantial amount of money. So, these are many examples. They're entertaining to read in some sense, but they're also quite sad because you realize quickly that it's pretty easy to get caught for this around unusual events. They'll look at acquisitions. They look at even hedge funds announcing short positions, and really it's not that hard to identify. If you're going to make any serious money from this, you're going to make an unusual trade, right? You're going to all of a sudden be buying lots and lots of shares or shorting lots and lots of shares in a very unusual fashion, and the SEC is going to notice that. So you could probably get away with buying like a small amount of shares or selling short a small amount of shares, but then you're not going to really make any profit, and then it's not worth it, right? Because you could still get caught, and then and you're not really benefiting. So overall, for all these people, their lives are quite affected. Reputation is all you have really in life and in business in particular. And when you get charged, the fines can be quite substantial. You probably have to return all your profits and then some in addition beyond those profits. And you're oftentimes barred from trading, so you can't participate in equity markets. And you also carry around an offense, and that can affect your ability to get another job in the finance world. And so it's very important to learn from other people's mistakes and don't repeat them. And this website is a very good way to learn what is illegal insider trading. And again, there's lots and lots of stories here. Thank you for your time. That was lecture 2.